Okay, let's move on and talk about the markets at large. Varun Lohchab, head of institutional research at HDFC Securities, is with us now. Varun, what have you made of this acceleration in the stock price of IT companies despite a dismal showing in Q1? Is this just a bit of a catch-up trade? Because, maybe the worst is behind IT, because we still appear to be some time away before we get any meaningful EPS upgrades. So is this rally over the last 2 days going to be a short-lived one, which gives you a pop of 5-7%, but no more? How would you view it, based on the fundamentals?
I think it's a tactical rally in the sense that IT sector has been one of the big underperformers, relative to rest of the market. But I think if you take a 12-month view, we believe IT sector is looking, well positioned in the relative context of the market, because most of the other sectors have run up and valuations are expensive. If you look at, two sectors where valuations are still reasonable relative to history is basically the two largest sector. One is banks and second is IT. Because these are well owned, they always remain finely priced. So therefore, there is no froth in the IT sector. While numbers will continue to be weak for next couple of quarters, we believe probably the same is getting reflected already in terms of downgrades. Even if you look at this quarter, despite say TCS, HCL Tech, and Wipro numbers not being great, the extent of downgrades have been minimal, and that too only in FY24 and FY25 earnings are not getting cut. So while near term we believe this is a tactical rally and may not offer huge upsides, but at the same time the downside is also fairly limited in IT. And from a 12-month view, one should look to accumulate this sector now. That has been our view for last few months when we have progressively cut our underweight call on the sector, and we are more now closer to neutral on the sector.
Okay, maybe can look at, starting to accumulate IT. Rima Sirbhi, we were talking about this earlier as well, right? So many fund houses are now deciding or saying that this is perhaps a good time to start buying. We had Axis, which launched the ETF very recently, around 2 weeks ago. DSP has come out with an IT fund as well. So looks like this theme is definitely, picking up. But Varun, the other theme you mentioned is the banking space, right? Take us to what you expect there. I know there is, expectation of a NIM contraction this time around, but how would you look at the banking stocks now ahead of the earnings?
So I think banking, there will be a bit of NIM contraction in Q1. We expect that to be 10 to 15 bips on a sequential basis. And this will actually accentuate a bit more in Q2. But if you look at this quarter, credit growth will still be healthy at around 15%. And credit cost will remain very low because asset quality remains pristine across the board. So, and valuations are reasonable. So we believe banks are, and that has been our call for almost 3-6 months. We are kind of neutral on banks, slightly overweight on select banks and NBFCs, but not on the index heavyweights. We believe it's a year where still you may not get valuation uptake in banks, given the fact that market will look through these peak earnings and they know that earnings are going to slightly moderate from here. But since earning growth itself will be healthy and will be around 23-24% as per us for FY24, you will still get a double-digit return in banks from these levels on a 12-month view. So it's a sector where one should remain reasonably invested, not to go heavily overboard, but one should be neutral to mild overweight in this sector. That has been our call.
Neutral to mild overweight. So Varun, when you say that, because you're keeping a more neutral stance, are you factoring in whatever margin erosion we might see? I mean, I'm just going back to yesterday's example. Federal came out with numbers. Margins fell all of 15 basis points, but the reaction was severe, not just in that stock, kind of triggered profit taking in the entire tier 2 banking space. What did you make of that? And is that factored in when you say be neutral on banks?
We have factored that in our estimates and so has the street, but we believe, unless the NIM moderation is more than expected, and right now we don't see any reasons for that. We don't think street will get overly worried or markets will get overly worried on NIM contraction, in our view. This was more of a, probably a knee-jerk reaction to, given the run-up in some of the PSU banks in the last couple of weeks. So some sort of profit taking, but I'll not get overly worried on that. So there is going to be a NIM contraction, which will keep valuations in check, but at the same time, the NIM contraction is not going to be so sharp that it will completely erode your earning growth on a YY basis. Therefore, some return can still be expected from banking sector and NBFCs.
Okay. Got that.
NBFCs are looking slightly better compared to banks from a next 6 month perspective.
Okay, NBFC is better than banks the next 6 months. Got that. Now, beyond financials, just tell us, where are you expecting, let's say, maybe even a positive earnings surprise or some phenomenal numbers? I know OMCs are one such space where I think most people in the market expect phenomenal, earnings inputs to come in for obvious reasons. Anything else that we should watch out for in terms of very strong earnings?
See, I think another pocket which has been delivering strong earnings for last couple of quarters, and we believe that will continue, is industrials, capital goods, and even construction, more capital goods. We are seeing very strong order flow out there. Margin pressures are also going to be behind us. So this space we have been quite positive on. Now, only issue is that stocks have run up very sharply, so we are struggling a little bit with valuations and whether fresh money can be allocated at these levels. One has to be fairly selective now. But I think from an earnings momentum perspective, this is clearly one of the strongest pockets, in the market. And I think the other place here where you will start to see some positivity is the broad mid-cap, small cap, all commodity consumer kind of companies. If you see mid and small caps, the earnings were really hit badly in the last 12 months when commodity prices went up and interest rates went up, because the smaller companies are far more sensitive to those two, given the pricing power is not very high. Now, as those pressures ease off, you'll start to see strong earnings recovery and rebound in some of these small and mid cap sectors across manufacturing, across some of the commodity consuming sectors. We saw that for the first time in Q4 when, in our broader coverage universe of 220, 230 stocks, after several quarters, for the first time, we saw 60% of the companies beating estimates vis-a-vis 40, 45, which were doing prior to that. And we believe this quarter, again, that number will be high and maybe even higher than 60, 65. So you will see more broad basing of earnings in the small and mid cap sectors, and therefore, one should remain positively inclined towards bottom up stock ideas from such commodity consuming small and mid cap sectors.
Okay, we'll leave it there for now. Thank you very much for joining in. Get into a break. On the other side, we'll come back and discuss Bandhan Bank, what to expect from the Q1 numbers today. We'll get you the key expectations.